A currency disappeared in 72 hours. Not slowly, not predictably. And the businesses that survived did something most CFOs would never approve in stable times. But what's happening now isn't about Venezuela. It's about the mechanism. The way credit facilities tighten when spreads widen. The way working capital evaporates when payment terms collapse. And the reason industrial buyers are suddenly stockpiling physical commodities they normally lease. The pattern is repeating. And the first signal most operators will notice is when their largest supplier suddenly demands, "Welcome to currency forensics." If you'd find this type of analysis valuable, I'd be grateful if you'd consider subscribing. And if you're willing, please comment below with your city or country. It helps us understand who's paying attention to these shifts. Between January 7th and January 10th, the Venezuelan bolivar stopped functioning as currency, not in theory, in practice. Gas stations refused it, grocery stores stopped pricing in it, and the official exchange rate published by the government became irrelevant within hours. Street dealers quoted 400,000 bolivars for a single dollar, a rate so extreme it suggested the currency had crossed into terminal collapse. Families holding savings in bank accounts watched their purchasing power evaporate in less than 72 hours. But the event itself is not the story. The story is what happened in markets that had nothing to do with Venezuela and everything to do with how corporate balance sheets absorb shocks they never modeled. Within 48 hours of the bolivar's collapse, premiums on physical silver spiked. Not the paper price traded on futures exchanges, but the actual cost of acquiring a coin or bar for delivery. Dealers reported premiums of $8 to $12 over spot, meaning businesses that needed silver for industrial use were suddenly paying 30% more than the quoted market price. This was not speculation. This was supply chain breakdown. When a currency dies, forward contracts become unenforceable, payment terms collapse, and buyers who normally lease commodities or rely on just-in-time delivery are forced to stockpile. The premium spike was a liquidity signal, not a price signal. It meant the normal flow of metal from refinery to manufacturer had fractured. But the real pressure was building somewhere else. In corporate treasury departments across Latin America, and in credit divisions at regional banks, a different calculation was underway. Venezuela's sovereign bonds had just been effectively wiped out. Credit rating agencies were reviewing every issuer with exposure to the region. And credit default swap spreads on neighboring economies began widening. This is where the mechanism starts. Many corporations use investment-grade sovereign bonds as collateral for credit facilities. When those bonds get downgraded, the collateral loses value. When collateral loses value, banks issue margin calls. The company must either post additional collateral or accept a reduction in available credit. For businesses operating on thin liquidity, this is not a minor adjustment. It is a forced deleveraging event. The timing could not be worse. Second quarter debt maturities are approaching for hundreds of companies across the region. Businesses that plan to roll over short-term commercial paper into new financing are discovering that the market has repriced their risk. Spreads that were manageable 3 weeks ago have widened by 200 basis points. Refinancing costs have spiked. And credit committees that once approved renewals automatically are now requesting updated cash flow projections and additional covenants. The trap is now visible. A currency collapse in one small economy triggered a reassessment of credit risk across an entire region. That reassessment raised borrowing costs precisely at the moment businesses need to refinance. Companies with leverage ratios above 3 times EBITDA are suddenly facing covenant violations they did not anticipate. If spreads widen another 100 basis points, the violations become automatic, and automatic violations trigger acceleration clauses, meaning the debt becomes due immediately. Meanwhile, the businesses that import commodities are facing a different crisis. The same supply chain fracture that spiked silver premiums is hitting industrial metals, rare earths, and agricultural inputs. Contracts that assumed stable currency exchange rates and predictable delivery schedules are breaking down. Suppliers in affected regions are demanding payment in dollars upfront with no credit terms. For manufacturers, with 60-day payment cycles built into their working capital models, this is a cash flow emergency. Inventory that was supposed to arrive over the next quarter must now be paid for immediately. And the dollars required to make those payments must come from credit lines that are simultaneously being reduced. The companies caught in this vice did not make reckless bets. They followed standard treasury practices. They assumed credit would remain available, currencies would stay within normal ranges, and suppliers would honor existing terms. Those assumptions are now being tested. And the businesses that modeled their liquidity needs based on those assumptions are about to discover how quickly a distant crisis becomes a local insolvency problem. The next 72 hours will clarify who has excess liquidity and who does not. Because on January 15th, the first wave of margin calls comes due, and the companies that cannot meet them will be forced to. The margin calls arrived on schedule, but what happened next was not visible in any public filing, or reported in any earnings call, or disclosed to shareholders. It happened in private conversations between treasurers and lenders, credit committee meetings that were moved up by 48 hours, and in emergency board calls convened over weekends. The question being asked in those rooms was simple. Where do we find the cash? Most businesses operate with the assumption that credit is renewable. A company borrows short-term, uses the funds for operations, generates revenue. And when the loan matures, it simply borrows again. This is called rolling over debt. It works perfectly until the day it doesn't. And for dozens of mid-sized companies across the region, that day arrived the week of January 15th. The problem was not that banks refused to lend. The problem was the price. Interest rates on new commercial paper had jumped by 300 basis points in less than 10 days. A company that was paying 4% on its short-term borrowing in December was now being quoted 7%. For a business carrying $200 million in rolling debt, that difference represents $6 million in additional annual interest expense. $6 million that was not in the budget, not modeled in cash flow projections, and not supported by current margins. The treasurer has three options: accept the new rate and absorb the cost, which means cutting expenses elsewhere; reject the new rate and seek alternative financing, which may not exist; or default on the existing debt, which triggers cross-default clauses across every other credit facility the company holds. None of these options were discussed 3 weeks ago. Now, one of them must be chosen by Friday. But the pressure is not isolated to corporate borrowers. The banks themselves are recalculating. Regional lenders with significant exposure to cross-border loans are watching their non-performing loan ratios tick upward. A loan is considered non-performing when payments are more than 90 days overdue. In stable times, NPL ratios hover between 2 and 4%. By mid-January, several regional banks are reporting ratios approaching 8%. This is not a crisis yet, but it is a warning, and regulators are paying attention. When regulators see NPL ratios rising, they mandate higher capital reserves. Higher capital reserves mean banks must hold more cash against potential losses. More cash held in reserve means less cash available to lend. Less lending capacity means credit tightens further. And credit tightening forces more businesses into distress, which raises NPL ratios again. The loop is now feeding itself. There's another layer beneath this: money market funds. The institutions that provide short-term financing to corporations by purchasing commercial paper are also reassessing. These funds are marketed to retail investors as safe, liquid alternatives to savings accounts. They promise stability, but that stability depends on the quality of the paper they hold. And if the paper they hold is suddenly downgraded, the fund faces redemption pressure. Investors pull their money, and the fund must sell assets to meet withdrawals. When money market funds sell commercial paper, they remove a critical buyer from the market. And when a critical buyer exits, prices fall, yields rise, and borrowing costs spike further. This is already happening. 3 large money market funds with exposure to Latin American commercial paper announced redemption gates in the 3rd week of January. A redemption gate is a temporary freeze on withdrawals. It is a polite way of saying the fund cannot return investor money without triggering a fire sale. The funds did not collapse, but they stopped buying new paper. And for the companies that depended on those funds to roll over their debt, the market just became much smaller. The businesses caught in this cascade are not reckless. They are manufacturers, logistics companies, agricultural processors, mid-market firms with stable operations and long track records. But they share a common vulnerability. They built their capital structures assuming short-term credit would always be available at predictable rates. That assumption is now being stress-tested in real time. And then there is the physical side. The companies that actually use silver and other industrial metals in production are facing a different calculation. Premiums over spot are now running at 40%. A manufacturer that budgeted $32 per ounce for silver inputs is being quoted $45. The company has 3 choices: pay the premium and destroy margins, halt production and breach customer contracts, or attempt to hedge with futures contracts, which may not be honored if counterparties cannot source physical delivery. Each option leads to losses. The only question is which loss is smallest. By the final week of January, the pattern becomes clear. The businesses with the longest cash runways are surviving. The businesses with leverage above 4 times EBITDA are being forced to liquidate assets. And the businesses dependent on continuous access to short-term credit are discovering that continuous access was always conditional. The condition was stability, and stability just ended. The data that will determine what happens next is not scheduled for release until February 3rd. A major regional bank is required to publish its quarterly loan loss provisions. If that number exceeds 12% of outstanding loans, the bank will be forced to raise emergency capital. If it cannot raise capital, regulators will intervene. And if regulators intervene in one bank, every lender in the region will be reviewed. The market is waiting for February 3rd, but some companies will not make it to. The first visible failure was not a default, it was a dividend suspension. A mid-tier industrial company with 30 years of uninterrupted payouts announced it was temporarily pausing distributions to preserve liquidity. The stock dropped 18% in a single session. But the real signal was not the share price. It was what the suspension revealed about internal cash flow. When a stable company suspends dividends without warning, it means one of two things. Either cash on hand has fallen below the threshold required to operate safely, or management expects cash flow to deteriorate rapidly enough that preserving every available dollar is now the priority. Both interpretations are bad, and both started appearing in analyst notes within hours. The suspension triggered a second mechanism. Credit rating agencies that had the company listed as investment grade began formal reviews. Investment grade status is not symbolic. It determines access to certain bond markets, eligibility for pension fund portfolios, and the interest rate a company pays on new debt. A downgrade from investment grade to high yield adds 2 to 4 percentage points to borrowing costs immediately. For a company already struggling to refinance, this is often terminal. 3 days after the dividend suspension, the rating was cut, and within 24 hours, 2 more companies in adjacent sectors announced they were evaluating capital allocation priorities. That phrase is code. It means dividends are next. It means buybacks are frozen. It means every non-essential expenditure is being reviewed. And it means the board has been told the business is entering survival mode. The cascade was now moving laterally, not just through credit markets, but through real operations. A construction firm with projects across 4 countries announced it was halting work on 2 sites, not because demand disappeared, because the cost of materials had spiked beyond what fixed-price contracts could absorb. The firm had signed agreements to deliver completed buildings at a set price. It had purchased materials in local currency, expecting normal exchange rates to hold. But the currency had devalued by 30%, and the cost of importing the remaining inputs had doubled. The firm now faced a choice: complete the projects at a guaranteed loss, or breach the contracts and face litigation. Completing the projects would drain working capital and potentially force insolvency. Breaching the contracts would destroy the firm's reputation and trigger penalty clauses that could exceed the cost of finishing. Neither path led to survival. The firm chose breach, and within a week, the lawsuits began. But the breakdown was not limited to construction. Retailers that imported goods for resale were discovering their inventory had been mispriced. They had purchased stock in dollars when the exchange rate was stable. They had priced it for sale in local currency, assuming that currency would retain value. It did not. Now the inventory sitting in warehouses represented a permanent loss. It could not be sold at a profit in the devalued currency. It could not be returned to suppliers. And it could not be restocked at new prices because working capital was now tied up in unsellable goods. The mechanism here is critical. Inventory is supposed to be a liquid asset. It sits on the balance sheet as something that can be quickly converted to cash. But when currency devalues faster than inventory turns, it becomes a trap. The business owns the goods, but cannot move them at prices that recover cost. And banks that lent against inventory as collateral are now requesting revaluations. When inventory gets revalued downward, the collateral supporting the loan shrinks. And when collateral shrinks, margin calls follow. The losses were now compounding. A food distributor that serviced restaurants across 3 regions had extended 90-day payment terms to its customers. Those terms were standard in the industry. But as restaurants began failing, the receivables became uncollectible. The distributor was owed $17 million in outstanding invoices. By the end of January, $9 million of that was more than 120 days overdue. And the restaurants that owed it were either closed or operating under bankruptcy protection. The distributor's lender reviewed the receivables, reclassified them as impaired, and reduced the company's credit line by 40%. The distributor now had less cash available, precisely when it needed to pay suppliers up front due to tightening terms. The company had 3 weeks of liquidity remaining. After that, it would begin missing payroll. This was the pattern repeating across sectors. A shock in one part of the system. Credit tightening, forced deleveraging, operational breakdown, and then contagion to the next weakest link. Suppliers stopped extending credit to distributors. Distributors stopped fulfilling orders to retailers. Retailers stopped paying rent to landlords. Landlords stopped servicing mortgages to banks. And banks stopped lending to anyone without fortress balance sheets. By early February, the labor market began reflecting the stress. A logistics company eliminated 200 positions. A regional airline suspended 3 routes and furloughed crew. A manufacturing plant reduced shifts from 5 days to 3. These were not headlines. They were footnotes in local business journals. But they were also leading indicators. When companies start cutting labor before cutting executive pay, it means the revenue model has broken. And when labor gets cut, consumer spending contracts, which reduces demand further, which forces more cuts. The political response was predictable. Governments facing revenue shortfalls from declining economic activity began announcing emergency measures, subsidies for key industries, temporary tariffs on imports, capital controls to prevent money from leaving the country. Each measure was intended to stabilize. Each measure made the problem worse. Subsidies had to be financed with new debt or money printing. Tariffs raised input costs for manufacturers. Capital controls trapped businesses that needed dollar liquidity to pay foreign suppliers. The reflexive loop tightened, and then, on February 8th, a previously stable regional bank failed to open. Regulators issued a statement citing temporary liquidity challenges and promised depositor funds were secure. The statement did not mention that the bank's loan portfolio had deteriorated so rapidly that capital reserves were now below the legal minimum. It did not mention that the bank had been seeking emergency funding for 6 days. And it did not mention that 3 other banks were now facing identical. The bank closure lasted 18 hours. When it reopened, depositors could access their accounts, but withdrawal limits were in place, $5,000 per day, maximum. For individuals, this was manageable. For businesses that needed to make payroll or pay suppliers, it was paralysis. The bank had not collapsed, but it had lost the one thing banks cannot survive without: trust. Within 72 hours, deposit outflows reached $2 billion. Customers moved their money to larger institutions perceived as safer. The bank's liquidity evaporated further, and regulators quietly began negotiations for an emergency acquisition. By February 15th, the bank had been absorbed by a larger competitor at a 60% discount to book value. Shareholders were wiped out. Bondholders received 30 cents on the dollar, and the acquiring bank immediately shuttered 15 branches and eliminated 400 jobs. This was the pattern that would repeat. Not dramatic collapse, controlled consolidation, the weak absorbed by the strong, at prices that transferred wealth rather than destroyed it. The businesses that survived the first quarter shared specific characteristics. They were not the most innovative. They were not the fastest growing. They were the most boring. Low leverage, high cash reserves, diversified revenue streams, and management teams that had lived through previous crises. A manufacturing firm that kept 18 months of operating cash on the balance sheet was considered overcautious in December. By March, it was one of 12 companies in its sector still operating independently. The firms that expanded during the crisis did so with surgical precision. A private equity group with dollar liquidity began acquiring distressed logistics companies in late February. The acquisitions were priced at 40 to 50 cents per dollar of book value. The group was not speculating. It was buying hard assets, trucks, warehouses, distribution contracts, at prices that guaranteed return even if revenue remained depressed. Within 90 days, the group controlled 23% of regional logistics capacity. Market share had consolidated, not through competition, but through forced liquidation. The question of silver resolved itself in a way most observers missed. The premium spike that began in January peaked at 52% over spot in early February. Then it reversed by March. Premiums had returned to 12%. The price surge was never about investment demand. It was about supply chain breakdown. When forward contracts became unreliable, industrial buyers stockpiled. When stockpiles were complete, demand normalized. The lesson was not that silver was a crisis hedge. The lesson was that any commodity with concentrated refining capacity becomes temporarily scarce when cross-border payment systems fracture. Businesses that understood this built strategic reserves. Businesses that treated it as a trading opportunity lost money on both sides of the move. By April, the economic damage was quantifiable. Regional GDP had contracted by 4.3%. Unemployment had risen from 6% to 11%. Corporate bankruptcies had increased by 170% year over year. But these were lagging indicators. The leading indicators had been visible in January. Widening credit spreads, rising physical premiums on industrial commodities, money market fund redemption gates, dividend suspensions at stable companies, payment term deterioration. The businesses that monitored these signals and acted survived. The businesses that waited for confirmation did not. The government interventions that followed were textbook: emergency lending facilities for banks, subsidized credit lines for strategic industries, temporary capital controls, currency stabilization efforts. Each measure addressed symptoms, none addressed structure. The economy had been over-leveraged, under-reserved, and dependent on continuous credit availability. The crisis simply revealed what was already true. And the policy response, while preventing total collapse, could not restore what had been lost. The families that escaped Venezuela in the opening days of the crisis did so because they had converted savings to portable value years earlier. Not because they predicted the exact timing, but because they understood the trajectory. A government printing money to finance deficits. A central bank promising stability while devaluing. A credit system built on the assumption that foreign lenders would always roll over debt. These conditions do not resolve. They either stabilize through painful adjustment or they collapse. Venezuela collapsed. The region adjusted. The difference was a matter of degree, not kind. The strategic lesson is structural. Businesses that survive dislocations of this nature do not predict the future. They model for improbable scenarios and maintain excess capacity specifically for improbability. Cash reserves that seem excessive in stable times become essential in crisis. Credit facilities with wide covenant headroom appear wasteful until spreads widen. Supplier diversification across currency zones looks inefficient until one zone destabilizes. The survivors paid the insurance premium. The failures did not. By June, the crisis had passed from headlines. Markets had stabilized, credit spreads had narrowed, new lending had resumed, but the landscape had changed. 15% of companies that existed in December no longer operated independently. They had been acquired, merged, or liquidated. Employment in affected sectors remained 12% below pre-crisis levels, and the businesses that had consolidated market share were now positioned to extract pricing power for the next decade. The executives who made the right decisions in January did not do so with perfect information. They acted on pattern recognition. They had seen credit cycles tighten before. They had watched currency crises spread. They had experienced the speed at which liquidity can evaporate, and when the early signals appeared, they moved. Not because they were certain, but because the cost of being wrong was elimination. The crisis that began with a currency collapse in a small economy ended with a reshuffling of power across an entire region. The lesson is not that Venezuela matters. The lesson is that the mechanisms which destroyed the bolivar exist everywhere. Excessive leverage, continuous refinancing requirements, commodity supply concentration, cross-border payment dependencies, political intervention, and credit allocation. These are not unique vulnerabilities. They are standard features of modern financial systems. And the businesses that survive the next dislocation will be the ones that recognize the features, monitor the signals, and act before confirmation arrives. Because by the time everyone agrees a crisis is happening, the options have already narrowed. And the only question remaining is, who absorbs the loss?